Today I will be going over my top 3 stocks to buy right now. Jumping straight into this, we are starting with something many of you, it's no shock to you. Number 1, Celsius. Ticker on this one is CELH. This is a company that has been hated for the past 5 years. The stock hasn't really gone anywhere the past 5 years. And yet this brand is something that keeps getting more relevant and more relevant over time. So in the past 6 to 8 months, stock is down roughly 60%. The all-time high on this stock is even close to $100. It's sitting around 27 today. Very hated, but let's go ahead and see what's under the hood. What's the growth rate of this company? What's the actual value, the PE ratio, the PEG ratio? What are we looking at here? So revenue, 31% this year, projected 9% and 8%, so 8 to 10% the next few years. What's the EPS growth? Well, 20% expected this year, then 22, then around 13%. So growth is still here, high single digits revenue, mid, teens for EPS. I personally think they're going to do a little better than that, but this is what analysts are projecting. What about the value? Well, Celsius is down to a forward P of 17. For a growth company, keep in mind, average stock in the stock market, 16 to 20 PE. Right now, they're a little bit higher than that, but we have a 17 on Celsius. Keep in mind, growth that's much faster than the average stock in the stock market. So PE, this used to be a company that had 30, 40, 50 PE in the past. Now we're down to 17. PEG ratio, around a 1 for a growth company, quite low in my opinion. Price to sales. This is a company that used to have a price to sales 5, 10 in the past, now down to 2.3 price to sales, which is something that has continued to drop over time. So we have a forward P that's dropping, but growth that's still quite strong and projected to hold up over time. So do I think this sell-off is justified, or why do I think this company is a buy? Well, let me show you my projections. So 8% revenue growth, 14% net income, right around where analysts have this estimated at. I personally think it's going to be a little higher than that, but just to be safe, I like my base cases a little bit safer. So 14% net income, PE ratio, I would say 25 is right around justified. Personally, for a consumer discretionary name like Celsius with growth way out into the future, international growth, the Pepsi distribution they got, acquiring Alani, bringing that on, getting the margins a lot better for that. I think this is low, 14%. I think it's closer to 20% in my opinion, but playing it safe. 14% net income, a PE ratio of 25, which I think is fair. We get a 25% CAGR over the next 3 to 5 years. But what's even more amazing for me, look at the bear case. Only 8% net income growth, which would be horrible for Celsius. 18 PE, roughly fair. You still get a compound growth rate of 9 to 10%. That's in line, maybe a little better than the market for a bear case. So this is why I think it is an incredible opportunity. So what prices am I looking at here? Currently around 27 per share. Anything between 20 and 30, I'm a buyer. Give me every share in sight. I want it all. If this goes 30 to 40 range, I would be still a buy. I think it's still a buy in my opinion, but not as exciting. 40 to 50, I'm more of a hold if it goes to 40 or 50. Now keep in mind, if growth accelerates more than it is now, maybe that would be a buy in the future, but 40 to 50, it's more of a hold for me. So that's Celsius. Number 2 on my list, Adobe. Ticker is ADBE. Now, what's my opinion of what Wall Street thinks about this? Don't even talk to me. This is like the ex-girlfriend that you just don't even want to talk to her. She don't want to talk to you. But it used to be something loved in the past, but it is hated right now. That is Adobe for you. This is a company that used to be almost $700 a share. Just in the past 2 years, it's down roughly 65%. This is a SaaS company that used to command a very high PE and forward PE ratio, and it still has relatively good growth, as I'll get into right here. It's pretty cheap. So, revenue growth. This year, 11%. It's still projected to have somewhere between 8 to 10% revenue growth. And look at the EPS growth. 16%, 12%, and then 13%. So this is a company with high single digits. Keep in mind, they usually come in beat numbers. So it could be low double digit revenue growth. Great EPS growth, outstripping their revenue growth. But look at the valuation of Adobe. Forward P is down to an 8. Keep in mind, that's more than half of what the average stock in the market trades at. PEG ratio of 0.62. You could go back in history, and I don't think you would find a PEG ratio of 0.62 for Adobe ever. Very low. Price to sales ratio. This used to be over 10, closer to 15 in its past, down to a 3 on this company. That's pretty incredible. So again, we have forward PE that's dropping heavy. Growth is still strong, high single digits, double digits for revenue, even more for EPS. So is this sell-off justified in my opinion? Why do I think this is a buy? Well, look at the numbers. 8% revenue, 10% net income. That's conservative, in my opinion, from even what analysts have, what they're projecting. Maybe you could say it's right in line, but even then, 10% net income or EPS, 20 PE for a company growing at that rate. Arguably a little low, especially SaaS, but let's put up 20 in there. Let's be a little conservative. 33% CAGR. That's how hated this company is right now. Look at even a bear case. Say maybe AI comes in. SaaS is all, Wall Street hates it right now. They think AI is going to take over. Possible, but say it does have some disruption. Personally, I don't see it, but say there's some disruption, only 6% net income and EPS growth. Say a 14 PE, that would be fair for a company growing. Not great, a little lower than they have been. 17% CAGR, bear case. Say it's even worse than that. Say their growth slows to 3 to 4% net income. You're still right in line with the market. Incredible risk to reward, in my opinion. So what are my buys here? Personally, anything 200 to 250, I want it. Give me it all. The stock's currently 225. When it went under 200 about a month ago, full disclaimer, I was stepping in heavy. But 2 to 250, I'd say still a buy in my opinion. Not as good of a buy, but still a buy. Anything over 300, I'd say hold. Not really interested in buying over 300, but I would still hold it. So that is Adobe. Number 3. SoFi Technologies. Ticker on it is SoFi. SOFI. Another company in the past 6 to 8 months, down around 50%. SoFi is a fintech banking related company with incredible growth in the past and into the future. So let's go ahead, dive in. What can we uncover here? Look at the revenue here in the top right. 30% revenue. And then it's going to continue to be over 20% for the next 3 to 5 years is what I'm seeing here. Incredible growth. Look at the EPS outstripping it. Mid 30% at least for the next 3 to 5 years. Incredible growth on this company, but look at the valuation. Look at the EPS. Used to be an EPS, or sorry, forward P. Used to be a forward PE that was 200, then 60, then 40. Now it's down to a forward P of 25. Incredibly low. PEG ratio of 0.6, incredibly low. Price to sales has came down, used to be closer to 9, 10, down to 5. So again, if you've seen a trend going on here, forward PE dropping heavy, but the growth is still pretty strong. By pretty strong in SoFi's case, 20% plus, 30% plus on net income. So do I think this 50% sell-off is justified? Why do I think it's a buy? Well, let's look here. SoFi, 20% revenue, 30% net income for a base. That's right in line where analysts have it. That's personally where I think they're going to be growing. So plug in 30% net income here. 25 PE, in my opinion, is low. I could see a PE in 30 to 35 given the growth rate they're having into the future, but let's be conservative for this base case. 25 PE, CAGR of 26% the next 3 to 5 years. Look at a bear case. 20% net income, that would be horrible for them. 20 PE, probably respectable, could be a little higher than that, but let's keep it low. 10% bear case. That's incredible bear case. In line, maybe a little bit better than the market. Pretty incredible in my opinion. So, what are my ranges here where I would feel comfortable buying? Well, stock's currently 16 a share. 15 to 20, I'm a buyer. I want it. I'm going to keep adding it quite aggressively. 20 to 23 a share, I would say is still a buy. Not as exciting though. Anything over 23, I would stop buying. Not as attractive in my opinion, but definitely a hold from me. So these are my 3 companies. As you can see, it's a mix. We got consumer discretionary, SaaS, banking, fintech related, all these different companies, but a lot of them have sold off 40, 50, 60% the past year, been hated, but I personally see a huge opportunity here, but feel free to go and run your own numbers. What do you think they're going to do? Find a value that you feel comfortable with. See if it's something to look into. So that is the end of this video. If you find anything valuable, love for you to smash the like button. If you love this content, feel free to subscribe. I'd really appreciate it. And I'll see you guys in the next one.